Brandon Burns joins me here today, and you could learn what his team is up to by heading over to Vanguard1031x.com. That's Vanguard1031x.com. That's going to be a clickable link in the show notes. This episode is going to be all about 1031 exchanges. So, Brandon, I really appreciate your time here today.
It's a pleasure, Jack. Thanks for having me on, and I'm excited to have a conversation with you and appreciate your time and being able to be on your show.
So, when we hit record, you were mentioning that you're kind of a subset of a pretty small group in the real estate world with 119 exchange accommodators across the US. I mean, that is a pretty small pool.
It is, one of the things that I think is really interesting, and I didn't know when I got into this business, but Section 1031 became part of the tax code in 1921. However, from 1921 to 1992, you had to sell and buy a building in the same day, right? Buying one property in one day is really difficult. And so having to have two transactions in one day in order to have a really powerful financial benefit of avoiding and deferring taxes, it's a Herculean effort. So there was a court case. Somebody said, hey, this is kind of ridiculous. This is way too much. And so there's a court case that actually went all the way to the Supreme Court, Starker versus USA, in the early 90s. And they rewrote the rules as we know them today. And the tax code requires that you use a qualified intermediary, which were more commonly referred to as 1031 exchange accommodators. But the tax code requires that you use this, type of business in order to get the tax deferral, the tax benefit. So let's do that. And so it's a very niche industry. The cost for doing an exchange is very low. So it's, a little bit over $1,200 all in when you're said and done. There's a limited number of companies that do it. There's a certification for the industry called a Certified Exchange Specialist, or CES. And that's kind of the equivalent for the 1031 exchange industry, like a CPA or certified public accountant is for the accounting industry, or a certified financial planner or CFP is for the financial advising industry. So I had that designation, and I think I'm about one of 70 or 80 people in the United States that do. I joke with my friends sometimes and say, I really enjoy being kind of the tallest midget, but it's fun to be in this space. I'm really grateful to be here, and I really enjoy it. It's very personally satisfying for me.
But you also mentioned that out of the 119 that do this type of service, this is typically kind of a low cost, situation. And a lot of these companies could be a little bit behind the times. Could you talk about most of them starting in the 1990s and what type of service that they should be looking for?
Yeah. So because the 1031 exchange is a low dollar item, right? We charge flat fees, $995 when you sell, $295 when you buy. And, we're kind of mid to low price compared to our competition. I think, 1031 exchanges probably range from, around $1,100 up to 2,000, right? So we're kind of on the lower end of that. So what's happened is that often people who look at this industry say, hey, we shouldn't have a standalone service that just focuses on 1031 exchange accommodation. We should do a number of things. We should do title insurance. We should do lending. We should do brokerage. And then they have the 1031 exchange as kind of a subset of their main, more profitable real estate business, right? Because so many sectors of real estate can do really, really well. Syndication, lending, brokerage, the list goes on. Title insurance, a lot of people don't know, is one of the most profitable types of insurance, because title insurance looks at past events while most other insurance looks at future events, right? Life, auto, health. What's the chance that something's going to happen to you? Title insurance says what has happened to you in the past. So title insurance only has about a 3% payout, because with the data that we have today, the title insurance companies can, have a lot of certainty around what they're insuring. So there's really few 1031 exchange companies that just focus on being a 1031 exchange company, that focus on those processes. Just a lot of other companies the 1031 exchange company is just a smaller subset of their main business. Of course, I'm biased, but because this is all that we do, and I have a great team of really senior people that have been doing this a long time, I think it makes us a little bit better at it. So, if somebody has a really complicated exchange or there's a little bit of uncertainty, we can really, really make a difference. And I think that separates us from some of our competition.
So you said this is all that you do. You must really be pushing through a lot of volume to keep the cost down where it is. This adds up to like $1,200 a transaction. That's not a lot to work with here.
Right now, we're probably facilitating between 40 and 50 exchanges a month. We're down a little bit because volume is down, but in a perfect world, next year we'll be back to doing 75 to 100 a month. Again, all we do, it's really helpful to kind of have that foot forward to the marketplace and people can know, hey, if I have a question, I know someone that I can go ask. And so I'm really grateful. I get a lot of referrals. I probably get 4 or 5 referrals a day and just sit down and take time with people and walk through their situation. I think with good data, people can really make good decisions. People are smart, but where people stumble is when they don't have the right data to make the right decision. In those circumstances, often they're going to make a decision that may or may not be right because they don't have the right framework in order to judge it properly. So that's a large part of my day-to-day focus, working with people, making sure they have the right data. And really our name even reflects that. So Vanguard isn't a common term that's used anymore, but it's a military term. And in past wars where, maybe there was less drones, less rockets and more foot soldiers, when a military force had an encampment and they had a perimeter and they were kind of bedded down, they were very safe. Then during the day, they would move to another kind of safe bedded down perimeter. And along the way, as the army marched, it at times could be a little bit vulnerable. There was a part of the military called a vanguard that would protect the main body of the army while it marched from secure location 1 to secure location 2 and just make sure there were no surprise attacks. So I really believe that's the exact same role that as a qualified intermediary or 1031 exchange accommodator that we do, right? As somebody selling a property that they feel comfortable with, and as they either diversify or reposition or move to a new property, our role is really to make sure that people don't have surprise attacks from the IRS. They know, hey, if I make action A, then I know there's going to be consequence B. And should I make action A, am I comfortable with consequence B? So that's something I feel grateful every day that I can take time and dig into people's situations and hopefully be a help.
Well, let's go there regarding like the general rules of a 1031 exchange. You mentioned when in 1921 when this all came to fruition, you had to buy and sell in a single day. What is the time frame? What's the purpose? I mean, it sounds like you could defer the capital gains on these properties indefinitely if you play your cards right.
Yes. So let me walk through that really quickly, just at a high level. Before I do, one of the ways I like to think about a 1031 exchange is kind of like this. Let's say that I am smarter than I am and I decided to buy Apple stock when they IPO'd, right? I put 10 grand in and maybe today that's worth 10 million, right? But as I look at Apple today, I say, hey, you know what? Steve Jobs isn't around anymore. The last couple iPhones haven't been any different. Apple stock has done really well for me, but I'm not sure it's going to continue to do well going forward. Maybe I want to switch that for Google. Maybe I really believe Google's going to do well. Well, in the stock market, you can't do that tax free. You sell your Apple stock, you pay taxes on the gain, and then you buy something else. When real estate, you can swap one for another. So that's what a 1031 exchange really allows people to do is to say, hey, I've got this asset. Maybe it's maxed out its value, or maybe I have accumulated a lot of wealth, but I don't have a lot of cash flow. And I want to reposition that asset into something that has a lot of cash flow. The IRS has 4 major hurdles in place. The first one, and most commonly known, is a time hurdle. So once a property sells, and to clarify, not once you go under contract, not once you list, the day you no longer own the property, 2 clocks are going to start and they're going to run simultaneously. There's an identification timeline. Simply the IRS, once people to come up with a plan and write it down. And that's a 45-day clock, 45 days to come up with a number of properties that someone may or may not buy and write them down. And they lock in at midnight on the 45th day. Then the IRS wants you to have purchased whatever you're going to purchase within 180 calendar days from the sale. So it's not 45 plus 180. They both clocks start and run at the same time simultaneously. So it's 45 plus 135. So it's very important that, a lot of people ask me, what if a property falls out of escrow, or is the IRS your friend? Will they give you an extension? And unfortunately, the IRS, they're not your friends. They're not warm and cuddly. They want you to fail these timelines. So that's typically the most known hurdle. The second hurdle, which is much less known, is a value hurdle. So when Section 1031 became part of the tax code originally, as with any new legislation, there were people that were for this legislation and there were people that were against it. And the people that were against it were saying, hey, listen, we think real estate people may be really smart. We think real estate people may be able to take money out of the economy without paying any taxes with this 1031 exchange legislation. And so the way that they wrote this part of the tax code, the IRS doesn't look at your basis, what you paid for the property. They don't look at the capital stack or what percentage is loan, what percentage is equity. What they do look at is what they call a net sales value. So they want the same amount of money to stay in the economy. So if you sell a property for $1 million, they essentially want you to buy a property for $1 million. Now, there's some closing costs you can write off, and we can get a little bit technical with that. But the general idea is if you sell for $1 million, you need to buy for $1 million. And that's true if you owe nothing. That's true if you owe 900,000. That's true if you bought the property for 50,000. That's true if you bought the property for 900,000. So it's important to be aware. And I think this is really important right now because a lot of people have bought great properties. It's had this significant run up in value, but the cost of debt is a lot higher today, right? And there's a little bit more uncertainty in the market than there has been in the past. So many people are saying, this is great. Bought a property for $1 million. It's worth $2. I owe 600,000 on it. I'm going to sell it and I'm going to buy a property for 1.4 with no debt. Certainly someone can do that. But in that situation, the IRS is going to tax them on the variance. So if you sell for 2 million, you essentially have to buy for 2 million. If someone is to buy for, in that scenario, 1.7, they're simply going to get taxed on that variance or the benefit. The IRS calls it mortgage boot, but essentially the benefit that they've received or that the IRS has perceived that they've received, right? So that's the second hurdle, and not as many people know that. And I think that's very important to be aware of. The third hurdle out of the four, so there's not too many here, is a financial hurdle. So one of the rules that they wrote in, the Supreme Court wrote in after Starker versus USA, is they said, okay, we're going to allow the time periods for this to happen, but we still don't want people to have control of the money. So you have to use a 1031 exchange company. And as a seller, you cannot touch the money. The tax code actually says you can't have constructive receipt of the funds. So it's just important to be aware of that in between the sale and the buy, your money is going to sit in a segregated escrow account. The third hurdle is a financial hurdle. And then the fourth hurdle is an ownership hurdle. This becomes really important if you have partners or a complicated trust or entity structure that you're running your business under. Essentially, the IRS wants to track these deferred taxes over time. So a 1031 exchange doesn't eliminate taxes. It keeps a taxable event from happening today. In order to track these deferred taxes, the IRS needs the sale and buy to show up on the same tax return. So when you sell, that's the same tax ID number that you have to buy under. Now, you can change the taxpayer that's on title before the sale occurs. You can change the taxpayer that's on title after the 1031 exchange is done because there's a clear record for the IRS to follow. You notarize a deed, you publicly file it with the county, right? So they can follow that. But if I was to sell a property under my personal name, and then you and I went and bought a replacement property under a partnership, then the sale is going to show up on my personal tax return. the purchase is going to show up on our joint partnership return, and the IRS is going to struggle to connect the dots. And so they're going to disallow the exchange. So this is very important to be aware of. I had a good friend who was a very accomplished real estate professional. And 2 or 3 years ago, we were doing an exchange for him. And last minute, he wanted to put his replacement properties in an S corp after selling them in his name. Luckily, we were able to catch it. If he had done that, then there would have been a taxable event. So kind of like to talk about that front and center and how important it is to make sure that the sale and subsequent purchase shows up on the same tax return. Now, not to get into a ton of math, but when I was in grad school, and this is why a 1031 exchange makes so much sense. When I was in grad school, I had a professor that talked about the other side of compounding interest. He called it a geometric average, which simply is if you have $1 and you lose half, you have 50 cents. If you then gain half, you don't have $1, you have 75 cents. So if you have a taxable event and you lose 30 or 40% of your gains, let's say you lost 30%, you are going to have to gain back like 41 or 42% mathematically just to get back to par, get back to zero. So a 1031 exchange can be really powerful over time because it allows you to compound your interest or, use compound interest to your advantage over a long time period without having a lost decade, right? The last 4 or 5 years, depending on what asset class and where it was located, some people doubled the value of their real estate. I don't know if it's going to be as easy to do that going forward. So if going forward, we're averaging 5 or 10% returns, how long is it going to take somebody to get 40% return on their money, right? In my opinion, probably at least 4 or 5 years, maybe more. So by doing a 1031 exchange, you essentially get to avoid those kind of lost 4, 5, 6 years where you're just struggling to get back to where you were. And so that's one of the reasons that a 1031 exchange can really be powerful.
Well, this has been so insightful so far, Brandon. Before we move on, because the next questions are going to be around how do you select the proper accommodator for your particular needs. I want to remind everybody to head over to your website. It's vanguard1031x.com. And if you're finding this information useful, maybe you have a buddy who's looking to do a 1031 exchange. Do us a quick favor, share this with your investor friend. If you're watching us on YouTube, also give us a like and a subscribe. With all of that, Brandon, I got to back up just a bit there. When you said about moving that money into a different investment, you said you got to keep it in the same type of entity. Can you use these funds to decide to become more passive and invest in like a REIT?
Great question. So in section 1031 of the tax code, the IRS describes a 1031 exchange as a like kind investment. And, to me, like kind means if you sell single family, maybe you have to buy single family, but that's not how the IRS defines it. So the IRS defines like kind as real property where you go on title. So there's a lot of flexibility there. You could sell a single family home. You could buy a hotel. You could sell a hotel. You could buy multifamily. You could sell multifamily. You could buy land. You could sell land. You could buy a shopping center, sell a shopping center, buy an office building. Now, I probably don't recommend buying an office building right now, but the point is the definition is very broad. There is one exception. In 2004, the IRS, after being lobbied for a number of years, said, hey, we understand that there may be a circumstance where somebody doesn't want to buy more real estate and continue as an active owner. And so they allowed one type of real estate fund called a Delaware Statutory Trust to be eligible for these tax-free dollars. Now, most people are much more familiar with a REIT or a real estate investment trust or a syndication or other types of fund structures. A Delaware Statutory Trust or DST is the only fund structure you can put these pre-tax dollars in. And the reason for that is because the IRS put some restrictions on it to try to make it somewhat safe. So they put a restriction of you can't do developments or even move structural walls. You can't refinance it. So among a number of other things. And so they really designed it to be something where it's kind of a steady Eddie. You buy something core plus. So that's the only type of fund structure you can go into. Now, there is a way to partner or invest passively with other folks. And that structure is called a tenant in common. So when you buy a property, if you go on title by yourself, it'll show on title your name or your entity as the sole owner. If you were to buy with someone else and both of you are on title, that's called tenants in common. So if you and I were to partner up on a project and I said, hey, Jack, I've got all the money. I'll put it in, but I need 60% ownership. And you say, hey, you don't want to put a ton of money in, but you're going to find the deal, a lot of sweat equity, a lot of work. And you say, hey, I think it's fair. I get 40% of that. So title would read Brandon Burns as a 60% owner and Jack as a 40% owner, tenants in common. So that's a way that you can partner or kind of often invest with a syndicator or do a joint venture using that structure. So it's a little bit different in order to be compliant and not have to pay those taxes. It's really nice that the definition of like kind is so broad and there are some options where you can partner up with folks and be more passive.
So with all of that, we initially started off by saying there's 119 accommodators across the United States. That doesn't sound like that many, but in most cases, it seems like out of those 119s, this piece of the business is kind of a tack on or an afterthought. What type of questions should somebody be asking to make sure that they're working with the right team?
For sure. So one of the things that's a little bit interesting is as you look at the United States, different states have different rules around closing properties. So, for example, the Northeastern states use closing attorneys. The Midwestern states and most other states outside of California use title companies, and California uses escrow companies. As you're looking at your closer, it's important, I think, to ask them, is this your main business? Have you done this before? Rather than finding someone that maybe hasn't done it in a while. And I think that's also true for a 1031 exchange company. So, I'd ask them, is this your main business? Are you a large national corporation, publicly traded? Are you a regional company? Are you a one person shop? And understanding if you need to get a hold of them, who are you going to be talking to? And what does that process look like to get your questions answered? Two, I would ask them, do you have all of the right insurance and bonding in place? And also, do you keep our funds segregated? So one of the important things and best practices is that there's a separate escrow account set up for each individual exchange. And most 1031 exchange companies do that. I've heard of some that don't. So I think that's a question that I would ask if I was trying to evaluate a 1031 exchange company. And then lastly, I would ask, do you have any certified exchange specialists on your payroll? So, again, having that designation, in order to get that designation, you have to have been in the industry for a fairly long time period. You have to pass a number of tests. You have to pass continuing education. And so that's a good way to kind of quickly ascertain if the company that you're dealing with kind of stays up on everything really well and has been around for a while and has a minimum level of knowledge. Kind of like with a CPA, right? If you're interviewing somebody to do your taxes, I'd ask them, you know, are you a CPA or are you a bookkeeper? Is this your first year or have you been doing this a while? So I think those are good questions.
Well, Brandon, this has been a fantastic conversation.
Yeah.
Is there a question or concept you wished we would have covered so far?
I think those are the key things. We talked about the four major hurdles. We have time, value, financial, and ownership. We talked about what is like kind, talked about how you can potentially be more passive. I think those are key things. Oh, there's a couple of different types of exchanges. So a normal exchange is a forward exchange, sell a property, buy a property, fairly straightforward. You can also do a reverse exchange. And a reverse exchange costs a little bit more. It's a little bit more complex. We are able to take all the risk off the table, right? So, I think 2 and 3 years ago, people would get offers for their property and they think this person is smoking crack. There's no way my property is worth this amount, right? I kind of vividly remember this. A gentleman in Houston calls me and he said, I'm looking at an offer. It's for 10 million. My property's worth 6. I need to accept this right away before they realize what they've done, but I need to understand the tax consequences. So I think before, people were willing to kind of rush into things because they were getting this huge premium on their properties. Now, sometimes people want to be a little bit more intentional, which I get. And if someone is worried that they're not going to be able to find a great property in the time frame allocated, they can do a reverse exchange, which they go buy something and then you sell what you have. So you take all the time frame risks off the table, you take the replacement risk off the table. Can be really powerful. Of course, every coin has two sides. So, that's the good side of the coin. The bad side of the coin is that it costs a little bit more because the way the IRS wants that structured, they want title to be parked. It's what they call a parking arrangement for title. So that when an exchanger buys that replacement property, their name doesn't go on title. There's a special purpose entity called an exchange accommodation title holder that temporarily takes title to the property. And then there's some additional legal fees because there has to be a really custom legal document that's drawn up that assigns all the rights to the exchanger. There's a promissory note created where they loan the money to themselves for $0. There's a lease created, all signing rights are so effectively the exchanger is the owner, but because there's that legal and title work, it does cost a little bit more. And then the other question becomes, until the money that's in your property that you're selling is freed up, how do you buy what money do you use to buy that replacement property in the meantime? So sometimes you have to get some bridge financing. So, but if somebody has the means to do it, or it makes sense to pay a little bit extra for some financing in the short term, then it can be really powerful to be able to remove all this risk.
Well, Brandon, this has been fantastic. If you head over to vanx.com, you're going to learn more information about 1031 exchanges and how Brandon's team can help you with this process. It's vanguard1031x.com. That's going to be clickable in the show notes. But if you're ready, Brandon, we'll jump into some rapid fire questions.
Let's go. I'm ready.
What lie do real estate investors sometimes tell themselves?
What lie do real estate investors? One thing that I think a lie I told myself at one time as a real estate investor was that you can be passive owning real estate. I do not believe that if you're a single owner of real estate, it is ever fully passive. Even if you have triple net, you could potentially have a lease, someone trying to break a lease. So I think sometimes people think that real estate can be passive, and it can be if you have a partner that's doing the work, or you've invested in, like a DST fund or even a REIT or, what have you. But if you're the only owner of the property, I do not believe it is a fully passive thing.
If you could go back in time and give your younger self one piece of advice, what would that be?
So I really like real estate. Personally, financially, I'm significantly overweighted in real estate in a way that probably financial advisors would tell me isn't prudent. But I like it because you can do insider trading, right? So in the stock market, if you know more than other people and you act on that information, you have material non-public information, you act on it, you go to jail like Martha Stewart, right? In real estate or other private markets, if you know more than other people and you act on it, you can make money. You can remove the risk. So I really like that. I've never invested in crypto, but I think if I had a time machine, I would go back to 2012, buy a few Bitcoin, and then roll that into more real estate.
Do you have a book recommendation?
I'm not sure that I have a good book recommendation. One thing that I'm reading right now that it's a little bit off topic, but kind of interesting to me. I'm a big history buff. I think there's nothing new under the sun. And there was a book that was written that talked about how, from a geography perspective, there's actually 9 different almost countries in the United States. And it kind of goes through and talks about them. And I don't agree with everything it says, but it's really interesting to think about. I've lived personally New York, Texas, and California over time. And, New Yorkers are different than Texans, and Texans are different than Californians. And it's interesting to think about that. And actually, I'm going to answer another thing with this and tie it back to your previous question. I think a lie that real estate people may tell themselves is that you don't have to look at micro things as you invest in real estate, right? So people have asked me, Brandon, how's real estate doing today? I was like, well, multifamily in San Francisco is doing different than office in Miami, which is doing different than single family in Columbus, Ohio. So I think understanding local markets, having boots on the ground, not investing in areas you don't understand is very important for a real estate investor. The best real estate deals that I've ever been a part of are things in my backyard that came through relationships, often off market, right? Where I really understood and I was able to really look at some micro rather than macro factors. So yeah, I think that's something that I might tell my younger self as well is, don't say, okay, well, let's look at multifamily across the country or let's look at industrial across the country. I would really hyper focus asset class location. And if you do that, I think you can be a lot more successful than otherwise.
What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your business?
So my business is really interesting in that way, right? So with $1,200 margins, gross margins, if I go out and hire five people and I don't have a business for them, then I got to fire them, right? And so one of the things that's been really powerful for me is having technology that allows me to scale. So I have a front end and a back end system. On the back end system, we have the software where it automates a lot of things. We have it built in so that we don't have to go and put things in DocuSign, right? It's built into our backend software. It also copies people. So one of the issues that sometimes people run into is if you have an advisor that's not a realtor, it may be a CPA, maybe an attorney, maybe a financial advisor, what have you. If you have an advisor that's not a realtor, then a lot of times it can be difficult for that advisor to give you good advice because they don't know what's going on. So one of the things that I've implemented in our backend system is if someone has an advisor with the client's permission, of course, we can copy that advisor on all communication or major communication. So if someone's working with a financial advisor and they're saying, hey, we need to move some assets around, reposition them, change strategies, the financial advisor is kind of intimately aware of things happening as they happen rather than having to chase the exchanger down and ask for documents and the exchanger's filled out 40 documents in the process of this thing and they can't find it. And so I think that's been really powerful. And then on the front end system, I think people like to communicate in different ways, right? Some people like to communicate through social media, right? I post a lot of real estate content and educational content on LinkedIn, Facebook, even Instagram. My Instagram's at Brandon.the1031 guy. And I post a lot of content. And so sometimes people will see that and be like, gosh, I have this 1031 question. Let me ask it there. So sometimes clients want to communicate through social media. Sometimes they want to communicate through texting. Sometimes they want to communicate through email. Sometimes they want to communicate through phone calls, and everyone's different. And so our front end system, we've designed it so that you can text our office line and it actually goes into our CRM. So if you and I have a conversation on the office phone and we get off and then you're like, gosh, I can't remember exactly. And you text it, it comes to me, but it also copies the exchange officer. So now you've got two people that are looking at that text. And so that allows people not only to be communicated in the way they want to be communicated with, but also making sure that if, and I think I've seen this problem with other companies similar to mine, you have a great sales rep or you have a great relationship with somebody, but because they're great, maybe they're tied up half the day typically, or maybe they're in a lot of meetings, or maybe they're going and speaking somewhere, right? But it's still important you get your question answered correctly and quickly. And so on the front end, having multiple people that are able to pick up the phone, respond to emails, texts, and just try to communicate with people quickly, efficiently in the way they want to be communicated with has been really powerful for my company.
Well, Brandon, this has been fantastic. I really appreciate your time, Brandon. This was great to meet you and discuss this in depth.
I really appreciate your time as well. And I'm excited. I don't have a dog. I don't have a kid. I don't have a wife. So 1031 exchange is my whole life. So, if somebody calls me, it saves me from staring at my refrigerator and thinking about eating some more ice cream or pie. So I'm glad to be here.
Well, give him a call to save him from his dietary choices. Thanks, Brandon.